Your savings are losing value right now. Not from fees, not from a crash, from a hidden tax most people never notice. It is called negative real interest rates. Here is what that means in plain English. Your bank pays you 4% interest, but prices rise 5% a year. You earned money on paper, but you lost buying power in real life. That gap is the real interest rate, and it is below zero. Brent Johnson at Santiago Capital just published a report called Less Than Zero. Johnson is the strategist who coined the dollar milkshake theory. His new research calls this the most important force in markets right now. It affects your retirement account. It affects your home value. It affects every dollar you hold. And almost nobody is talking about it. In the next 10 minutes, I will show you exactly how this works. I will show you what happened every time this occurred before. And there is one chart from Johnson's report that changes everything. We will get to it. But first, you need to see the machine. Think of it like a bathtub with a slow drain. You turn on the faucet. That is your interest payment. But the drain is open. That drain is inflation. If the drain is bigger than the faucet, the tub empties. It does not matter how long you run the water. The same thing is happening to your money. Central banks set the interest rate. That is the faucet. Inflation is the drain. When inflation runs hotter than the rate, savers lose. Borrowers win. Speculators win even more. Look at this table from Santiago Capital's research. It shows real policy rates across major economies in May 2026. The United States sits at negative 0.6%. The Eurozone is negative 1.6%. Japan is deeply negative at minus 2.5%. These are not small countries on the edge. These are the biggest economies on Earth. Johnson's paper frames this as an addiction. The film Less Than Zero tells the story of a young man who does not choose ruin in one moment. He slides there through small choices. Each one feels manageable. Each one makes the next harder to avoid. That is how debt-based economies relate to cheap money. The next hit is always available. Relief is always offered. Pain is always deferred. But here is what the history actually shows. Every single time this happened before, it ended badly. Let me show you the record. Santiago Capital's report maps every major episode of negative real rates in the last century. There have been 4 big ones. The first ran from 1945 to 1955. Governments had massive war debts. They kept rates low and let inflation eat the debt away. Savers paid the price. Sound familiar? The second hit in the 1970s. Oil shocks drove inflation through the roof. Real rates went deeply negative. Stocks lost half their value when you adjust for inflation. The third was after 2008. Central banks flooded the system with cheap money after the financial crisis. Real rates stayed negative for years. Asset prices soared, inequality widened, and the fourth episode is now. It started around 2020, and it has not ended. Look at this chart of US 10-year real yields from 2003 to 2026. Notice how the line keeps drifting lower. By 2026, the trend is unmistakable. Here is what connects all 4 episodes. In every single one, the standard portfolio broke. The 60-40 portfolio splits your money. 60% in stocks, 40% in bonds. Bonds are supposed to rise when stocks fall. That relationship has been breaking down since 2020. Johnson's research shows exactly why. And what it means for your money is the part most people are missing. Here is where it gets personal. If you hold a standard retirement portfolio, this is already affecting you. The 60-40 model was built for a different world. A world where bonds reliably protected you when stocks fell. That world started cracking in 2020. By 2022, both stocks and bonds fell at the same time. That had not happened in decades. Santiago Capital's research includes a table of how negative real rates change everything. Stocks get pushed higher, not because companies earn more, because money has nowhere else to go. Gold rises, hard assets rise, cash loses value every month. Bonds, the supposed safe part, actually lose purchasing power. The question is not whether to adjust, it is how. Johnson's framework maps 4 scenarios for how this episode could end. 1 is financial repression. That is when governments quietly let inflation eat their debts while capping interest rates. You do not see it on the news, you feel it at the grocery store. Another scenario is a policy shock, a sudden rate hike that breaks something. Think 2022, but worse. There are 2 more paths, and the investment playbook changes depending on which one unfolds. That is what I want to show you next. Johnson's report lays out 4 paths from here: financial repression, policy shock, inflationary blow-off, or a deflationary reset. Deflationary reset means prices fall sharply, debts become crushing. Think the 1930s. Inflationary blow-off means the opposite. Prices spiral. The currency itself loses trust. Each scenario rewards different assets. But here is what surprised me. 2 asset classes show up as winners in almost every scenario. Hard assets like gold and commodities, and the US dollar itself. That sounds contradictory. Gold usually rises when the dollar falls. But the dollar milkshake theory explains why both can win. The theory says the dollar strengthens because the world owes trillions in dollar-denominated debt. When stress rises, everyone scrambles for dollars, even as real rates stay negative at home. Gold wins because savers worldwide need something that holds value. The dollar wins because borrowers worldwide need dollars to survive. Both forces run at the same time. That is the insight most standard models miss. In both scenarios, the investors who do well see the structure early. So where do you find research this clear? That is what I want to show you last. Let me bring it together. Real interest rates are negative across the developed world. That is not a glitch. It is a structural regime. It punishes savers. It rewards borrowers and speculators. It has happened 4 times in the last century. Every time, the standard portfolio broke. Every time, the investors who survived were the ones who understood the structure before the crowd did. I told you the investors who win see it early. This is how they see it early. Brent Johnson and Santiago Capital have built the most detailed monetary research I have found on this topic. The full less than zero report walks through every scenario. The math, the history, the specific asset playbook. The link to subscribe to their research is in the description below. Because the regime is running whether you are paying attention or not. The only question is whether you see the drain before the tub empties. Click the link, read the report, position before the crowd figures it out.